private equity has kind of gotten wrapped up with hedge funds when it comes to their fee structure and people being unhappy about that. But at the same time, private equity is also the best performing asset class, like Josh mentioned. Do you see private equity facing any problems with that fee structure in the near term, or if so, what's the alternative?
I mean, I think so much of the issue with fees on the hedge fund side has just been the payment's been there and the performance hasn't been.
Right.
I think if for the hedge funds, for example, that have had the performance, there's really not that issue with the fees. And in fact, they're in some cases higher than the 2 and 20 and have tens of billions of dollars and a line behind them if they're closed. On the private equity side, I think I mean, it's the same for any investment. If you're going to get that outsized performance, maybe you're not. Maybe happy is the wrong word to say that. You're happy to pay, but you're certainly okay paying because you're getting something to go with it. The venture panel before, the concept of even a premium carry on the venture side for the handful of firms, but the firms that have it and get it, it's because on a net basis, you'd still rather be there than be somewhere else. I think on the private side, it's really, it's 2, but by and large for us, it's less than 2 on the management side. It's 20, but you are having a preferred return, and then just depending on the structure of the waterfall, it'll net out to be less than that if it's somewhere in the catch-up range and at it if it's at the catch-up range. But I think it's the pendulum's definitely swung. Earlier panels just talking about the good funds are getting raised very quickly on terms which are everything sort of behind the math of the fee and the carry model and other things. So there's not a lot of pushing back successfully going on by us these days with very high in demand managers. However, we hope it's a fair discussion because we weren't taking full advantage of sort of having the upper hand the last fundraise back. We should be reasonable, we should be partners because we want to be with them for the long term and be with them for multiple funds.
Yeah, I think we do it direct or through partnerships. Somebody's got to do the heavy lifting, the work to create great companies. We traffic in the smaller funds where 2% or 2.5%, the management team's not going to make a lot of money on that. At the larger funds charging that, there's certainly some profit element in that. And we like long-term relationships where we've got loyalty, integrity, and transparency, and cemented with alignment. And we think alignment of interest is the most important. And we've got a manager that we're looking at where it's $100 million. The GP is putting in 10-15% of the capital, and the managing partner is not going to draw a salary. So that he's eating his own cooking, and we like that kind of approach to alignment of interest.
And I'm just not sure what we're a GP collecting fee and carry, but we're also an LP paying fee and carry, so we're sort of schizophrenic on it. But I think, just thinking about alternatives, I'm not sure, and just focusing on the management fee for a minute, I know there's discussion about fees on committed versus fees on invested, and I think the challenge of shifting to fee on invested is it really creates a perverse incentive for that manager to put the capital to work maybe more quickly than they otherwise would. And I think one of the things that we learned, and I think a lot of LPs learned coming out of the last financial crisis was, one thing you definitely want to do is pick good managers, invest consistently through cycles, and make sure you're well aligned with those managers. And so I think, the idea of putting incremental pressure on a GP to put money to work more quickly, I'm not sure that's in the best interest of the LPs.
I think a lot of the outcry is really in this country, so much so from the public pension funds and the disclosure, and it's a simplistic headlining type thing to put out there of just how many hundreds of millions of dollars, or for some bigger pensions, billions of dollars they've paid in fees over X period of time, but it has it's never really followed up by what the return has been on the fees paid. And by and large, if you're paying hundreds of millions or billions of dollars on, well, it's fees and carry, I mean, that part's neglected, and the carry's being paid because the fund has performed. Right. So I think, again, it's for the performance, and you're also seeing a lot of the larger funds that can do either reduce or in some cases eliminate their hedge fund exposure. I don't think there's a single entity that's doing that on the private equity side right now because of the success. Now, could it become crowded and it be arbitraged away? Yeah, I suppose on an overall basis, perhaps, but there's still going to hopefully be managers that are not just the average. But I think a lot of the controversy is kind of simplistic.
We've seen a couple of funds lately. I don't know if you have. They're very high-performing funds. They're great funds. And I'm not sure who's telling them to, sort of selling them on the story, but they're introducing performance. So if it's above a 2.5x net, the fee is X, or if it's above 3x net, then it goes here. And again, these are high-performing, in-demand funds that we did participate in, but I don't know how comfortable I feel with that. So that seems to be starting. That noise seems to be starting a bit.
Yeah, we've had that for a while with some of our performing venture growth funds in China, for example. Mm-hmm. It's been a concept that's been out there for at least a fund cycle, some 5 years or so, and in some cases it's sort of been arrived at in the reversed way, in the sense that they were pushing for a higher carry from the pref. And it was sort of, well, that higher carry can kind of come after, a 3x, for example. So it's actually been seen as a compromise as opposed to something getting taken away. But again, I think it's that concept of paying for performance, and maybe you're, more comfortable paying 25 or 30% when you're in that zone of, 3x, 4x, and beyond.